Welcome back to the Deep Dive. Today, we are taking a granular look at the Q1 fiscal year 2026 earnings for UniFirst Corp, ticker UNF. And we really need to dig into this one because UniFirst just delivered a classic tale of two companies. You've got strong sales on one hand, but a massive profitability miss on the other that, well, hit the stock hard.
Well, it's more than just a profitability miss. It's a high-stakes strategic narrative. We've got to break down for you why the stock opened so sharply lower. I mean, it was initially down over 7% when the revenue on the surface looked fine. And, what this all says about the colossal multi-year transformation they're attempting, all while a major unsolicited M&A proposal is just hanging over the entire operation.
Right. So that's our mission here. Cutting through all that complex noise, we need to understand the immediate pain the market is reacting to, and maybe whether management's promise of future gains can, truly justify the short-term margin destruction.
And to do that, we have to jump right into those friction points, starting with the headline numbers. So UniFirst, they showed solid revenue growth. They hit $621.3 million.
Which is pretty good.
It is. That's a respectable 2.7% increase year over year, and it actually beat the street's consensus estimate by about $1.5 million.
So why did investors treat this like a disaster if the top line was a beat?
Because the profitability metrics were completely derailed. I mean, just completely. Their diluted GAAP EPS, that's their, general measure of earnings per share, it came in at $1.89.
And the target was what?
The consensus target was $2.10.
Yeah.
So they missed by a very significant $1.21.
Okay, let's stop right there. For everyone listening, we need to get clear on the metric that really mattered here, the margins. Can you walk us through that contraction?
Absolutely. The market completely ignored the revenue beat. It treated this purely as a margin quality quarter. Operating income declined 18% year over year to $45.3 million.
18%? Wow.
Yeah, and that sharp decline just crushed their margins across the board. The operating margin fell about 190 basis points to 7.3%.
Can you quickly break down what 190 basis points means in real terms?
Sure. Think of 1 basis point as 0.01%. So 190 basis points is a 1.9 percentage point drop in their margin year over year.
That's a huge drop.
It's a steep, noticeable contraction. And their adjusted EBITDA margin, which is the metric investors often use to compare profitability with peers like Cintas, that dropped even harder. It contracted approximately 220 basis points to 13.3%.
Okay, so that signaled that their core business profitability is just severely under pressure right now.
Exactly. That kind of margin deterioration explains that initial 7.5% stock drop much, much better than the EPS miss alone.
So let's get into the why. Management pointed to three main factors for all this pain. What were they?
Okay, so the first two are ongoing strategic choices. First, you've got the planned investments. They are pouring money into their sales and service organizations, restructuring teams, adding people, all designed to accelerate long-term growth.
That's the classic short-term hit for long-term gain.
Exactly. Then the second factor involved some unexpected costs that were just pure drag. Specifically, higher than anticipated healthcare claims and some elevated legal costs during the quarter, which just added a layer of unwelcome volatility.
Which brings us to number 3, the biggest strategic bet of them all. That massive overhaul of their technology backbone, the Enterprise Resource Planning System, the ERP.
It's their key initiative. And the specific cost of this ongoing ERP project in Q1 was about $2.3 million pre-tax. And crucially, that expense reduced their diluted EPS by 9 cents.
But wait, hold on. If that cost only shaved 9 cents off their earnings and they missed the consensus by 21 cents, why is the market treating the ERP project like it's this catastrophe that's torpedoing the whole quarter?
That's a brilliant question, and it really gets to the market's true fear. That $1.09 is just the direct accounting cost. It's for the core finance modules they implemented in Q1. The real problem, the much bigger problem, is the indirect cost. The sheer distraction, the operational changes, the training, all the complexity that just stifles efficiency across the entire organization.
So the ERP isn't just a line item cost. It's a source of operational drag that's making other parts of the business less efficient and compounding the margin problem.
Think of it like a huge house renovation. While your kitchen is being gutted, your entire life is messy, it's costly, and it's inefficient. Management is basically saying, we're building a state-of-the-art kitchen, but right now, we're microwaving meals in the garage.
Okay, that makes sense.
It looks worse in the short term, but the idea is the long-term value will be significantly higher.
That analogy helps a lot. Management also gave some specific color on when this messy phase might be, right?
They did. They suggested that the year-over-year impact of these strategic investments all that sales and service team spending was most pronounced in Q1. The implication is that the worst of the investment drag should, ease up a bit as we move through fiscal year 2026.
And despite all this heavy spending, management is sticking to their long-term vision. They're still promising high teens adjusted EBITDA margins eventually. Are they giving investors any kind of firm timeline on that recovery?
No, and this is where investor skepticism really deepens. They reaffirmed the long-term goal of high teens margins and mid-single-digit organic growth. But they explicitly said, again, that no specific fiscal years have been set for achieving those targets.
So the long-term outlook is still pretty vague. What does that mean for the near term?
Near term, margins are expected to remain muted. That was the key word management used. They're now framing fiscal year 2027 as the pivotal inflection year, the point where the initial efficiency benefits of the ERP should start to visibly show up.
That is a long time to wait for investors who are looking at a 220 basis point margin drop right now.
A very long time.
Okay, let's pivot to the good news, because there was significant success on the top line. The investments must be working somewhere because they did beat revenue. Where did that strength come from?
The core segment, Uniform and Facility Services, posted solid 2.4% organic growth. And this growth was high quality. It was driven by two operational improvements that are absolutely central to their strategy. New account wins were higher than the prior year, and customer retention continued its positive trajectory. That's a second straight year of sequential improvement.
That signals that the money they spent on restructuring the sales organization, into that tiered model is actually driving market share gains.
It is. The tiered selling model, which focuses resources differently based on account size, it's proving highly effective in capturing the mid-sized customer demographic.
Which is key.
It's crucial because it diversifies them away from just chasing huge national accounts or tiny local businesses.
And we can't forget the high-octane growth in the first aid and safety solutions segment.
Right. That segment continued its robust momentum. It grew 15.3% in revenue. That's driven by expanding their van business model and some strategic bolt-on acquisitions. But, and this is a perfect example of that spend to grow dynamic, this segment is still operating at a nominal operating loss of about $0.4 million as they build out that whole engine.
So high growth, but it's still a cost center for now.
For now, yes.
And all this strong execution is being fought by a couple of macro factors that management brought up in the Q&A. What are the external headwinds that are kind of offsetting some of these gains?
The primary drag is softer employment and what they call wearer levels. Uniform rental demand tracks the number of people employed in industrial and service jobs, and management noted this is becoming incrementally more impactful.
So it's offsetting some of that strong new account growth.
Exactly. Basically, their customers are either hiring fewer people or they're reducing shifts.
So even with great sales execution, if the broader economy isn't adding wares to the system, growth is capped.
That's the problem. And they also flagged the need to monitor the potential impact of future tariffs on their cost structure. This just adds another layer of cost uncertainty to a balance sheet that's already struggling with all these investment costs.
If we pull back to the bigger picture, all this margin pressure and operational drag is only really possible because of one major strength we haven't given enough attention to: their balance sheet.
You hit the nail on the head. The balance sheet is UniFirst's superpower right now. They have $129.5 million in cash and short-term investments, and critically, no long-term debt.
That lack of debt is the only reason they can afford to absorb this multi-year, margin-muting ERP project. I mean, Q1 CapEx alone was, $38.9 million? They can do that without jeopardizing their financial stability.
Precisely. It gives them the flexibility to survive this whole strategic transition and handle the heavy capital spending. Competitors or firms with heavier debt loads, they might buckle under similar pressure. It's what buys them time to get to that promised land of fiscal 27.
So let's synthesize that promised land, the strategic cadence, and the ERP milestones. What is the big efficiency payoff that's scheduled for this pivot year of FY27?
Okay, so fiscal year 26 is foundational. They're implementing core finance modules. The big payoff comes in FY27. That's when key benefits kick in. Most notably, global inventory sharing.
Global inventory sharing.
Yeah, it means they can reutilize used garments across different facilities and regions, which leads to huge long-term savings on buying new merchandise. For a uniform rental business, that is a massive efficiency driver.
So they stop wasting money on new uniforms if they can just reuse their old inventory smarter.
That's the idea. Plus, they've got supply chain-centric procurement enhancements and new facility service products slated for launch. Management did warn, though, that the full impact of these gains won't be immediate. They'll phase in through the latter half of FY27 and into FY28.
This brings us to the elephant that is currently dictating the stock price, really overriding all of these operational metrics, the external M&A story.
Yeah, UniFirst is trying to execute this multi-year turnaround, but the board is simultaneously evaluating Cintas' unsolicited, non-binding $275 per share all-cash proposal, which they received back in December of 2025.
What update did management give regarding the Cintas bid?
Zero. Nothing. They provided no update or timeline on the evaluation process, and in what was a really clear signal of frustration, they explicitly asked analysts to focus their questions solely on the operational results of the quarter.
That deliberate silence just heightens the volatility, doesn't it? If the company is trading near that bid price, but the fundamentals look this weak, investors are clearly betting on the deal, not on management's execution.
Absolutely. The stock is priced right now based on the probability of a deal closing near that $275 mark, not based on the 13.3% adjusted EBITDA margin we just talked about. This strategic overhang creates immense uncertainty. It's the ultimate binary outcome for the stock.
We mentioned guidance earlier, but let's circle back to the full picture. Reaffirming the full-year guidance for FY26, it still contained a negative signal for the street.
It did. While revenue guidance was reaffirmed, the full-year EPS guidance of $6.58 to $6.98 remains a key concern, because the top end of that range is below the existing consensus of $7, which suggests management is internally forecasting operational challenges that analysts haven't fully baked in yet. It's a quiet acknowledgement of continued margin difficulty.
This is the deep dive, and now it's time for the segment where we explore these strategic tensions through a highly theoretical lens.
The one where we remind you that this is purely conceptual analysis and not investment advice. Please consult a qualified professional. We are simply exploring the concepts that are driving all this market volatility.
That being said, let's explore an outrageous but plausible volatility trade that sort of encapsulates the binary risk that UniFirst is facing. You have two massive, almost opposite forces at play here: the high M&A-fueled price floor and the low margin-muting operational reality.
The core thesis for a trade like this is just recognizing that the stock is completely unstable. If the Cintas deal retracts, or if the ERP transition fails or stalls, the stock price will collapse back toward its operational fundamentals, which Q1 suggested are pretty weak.
Yeah.
But if the deal moves forward or the ERP provides an early win, the stock moves sharply higher.
So how do we structure a theoretical bet on this high volatility binary outcome, leveraging that strategic review?
We'd structure a volatility hedge. It's designed to protect against disaster while capitalizing on a near-term strategic pop. The specific idea: a long-dated put option on the stock, which basically acts as inexpensive disaster insurance against that failure scenario.
So the long-term put hedges against that big downside risk, the failure of the ERP combined with Cintas retracting its offer. That would send the stock plummeting from its current elevated trading range.
Exactly. Then we'd pair that put with a short-dated call spread. This isn't betting on a huge move up, but it's betting on the next 12 to 18 months being volatile because of strategic announcements. The call spread capitalizes on any surprise positive catalyst like a definitive positive update on the M&A review or an unexpected early inflection of those FY77 ERP benefits.
That is a sophisticated structure. It's designed to acknowledge that implied 275 M&A price floor while protecting against the very clear operational and execution risks highlighted by this Q1 margin performance. It's a bet on the volatility of the uncertainty itself.
It is a perfect reflection of the tightrope that management is walking right now.
Thank you for walking us through the pretty complex structural situation.
My pleasure.
The ultimate takeaway here is that UniFirst is trying to execute a necessary yet painful and margin-muting operational transition through FY26 investing heavily in the ERP and sales, all while facing two significant external threats: that major strategic M&A question posed by the Cintas bid and growing macro headwinds like softer wearer levels and potential tariff costs.
Which leaves you, the listener, with the ultimate question to consider. Can management, with their strong balance sheet, successfully navigate these massive operational complexities and maintain service levels and sales momentum through this really challenging transition phase? Or will the board be compelled to pivot to the Cintas offer before the promised FY27 efficiency benefits ever fully materialize? That is the billion-dollar balancing act that UniFirst faces.
That truly is the ultimate question driving the stock. Thank you for joining us for this deep dive into UniFirst Q1 results. We'll catch you next time.